All right, good evening, everyone. Thank you for joining us either here in person, if you're on Zoom, or if you're watching this recording. As always, my name is Robert Cruz. I'm one of the principal partners here at the Lutz & Cruz Group, powered by Place. And as we do each week, we do a quick 20-30 minute roundup on what's been happening in real estate in Silicon Valley, so that you can have a better idea if you have questions about buying or selling in Silicon Valley, and whether that's buying or selling in the near term or in the long term, or if you just want to know more about what's going on in real estate. Typically, from other sources, you'll hear monthly, bi-monthly updates. We do it every single week, and there's a very important reason for that. There's very few places in the world, certainly in the country, where real estate moves as fast as it does here in Silicon Valley. And when you can get price moves up or down, lately just usually up 2, 3, 4, 5%, and that does happen, you're talking 20, 30, 40, 50, $70,000 worth of movement. So being a broker here in Silicon Valley for the last 20 plus years, coaching and training agents, and specifically on markets, on trends, on how to communicate to buyers and sellers about what's happening, I feel I've gotten a really good pulse on what's happening in our markets. We've developed some cool ways to communicate that to you as buyers or sellers or simply homeowners, again, interested in wanting to know more. And we want to share some of that tonight. We do it every week. We check each Monday morning. We download all the data on all sales, all listings, price corrections in the Valley, in Santa Clara County, and actually also San Mateo, San Benito, Contra Costa, and Alameda, just in case you're listening from anywhere in those areas. So I'll talk in generalities today. We'll start from a global view, what's going on nationwide, what's going on region-wide, and we'll bring it back down to the county. And what I want you to understand is, while I might be talking about a region and not necessarily your neighborhood or your home, the kind of analysis I'll present to you tonight, we can do and we will do for your specific needs and wants if you're looking in a particular area to buy, or if your home is situated somewhere and you're wanting to know what's going on in my neighborhood. Give us a call. Anyone that invited you or shared this recording with you, reach out to them. We'll set up a quick in-person or Zoom 30-minute, 20-minute, really precise and unique to your situation presentation along the lines of what you're going to hear tonight. So with that, we'll jump in. As always, if you have any questions, raise your hand either in person or digitally here on the Zoom, and I'll answer them. My clicker's always letting me down lately. Luckily, I've got the backup here. So I'm going to start right here. This is existing home sales. This is across the country. This is from a website that I love. If you want to go and follow some real estate trends yourself, wolfstreet.com is a great place to do it. I will warn you, he is a bear. He's almost always finds the worst in every data point and number. I've built thick skin, so I can take his analysis quite easily. But it does have great information, great graphs like this one, and that's where I'll start. So based on this chart written below, this is from a tweet from Amy Dixon from Dallas-Fort Worth housing and economic analyst. And she writes, "The Fed has a huge problem on their hands with housing. Last time market activity crashed with low inventory was spring 2020. We all know what happened then. That was the lockdown. That's when COVID first hit. Not only real estate, but all industries were shut down. And obviously, people weren't listing their homes. They didn't know they could sell them. Makes sense. The way out of that was to stimulate demand. It's stimulated by artificially lowering interest rates, making money really cheap, really easy to borrow, and people did. And they went out and purchased small, medium, large size things like houses. And you can see that spike from that immediate crash back up to almost the heights of 04, 05. Now the market activity has crashed again. Very important word in there. The word that most people latch onto is crash. And that is a crash, but it's a crash of activity, not of prices. Last quarter, even early 2023, people were talking about crash in prices of houses, thinking with economic troubles, with interest rates so high, with a 12-year run up in prices, finally, real estate prices would crash and move downward instead of upward. Has not happened, and we'll go into more of that. But a crash has happened, and that's an activity. Number of properties for sale. That's going to matter to you, whether you're a buyer or a seller in this market. And we want to start here. Always start with the obvious. Way fewer transactions in our market. What does that mean? You can see when the last time we were this low in number of transactions nationwide was at the start of the pandemic in 2020 and at right near the end of the global financial crisis in 08, 09, 010. When you're talking about almost anything, you don't want to be compared as the last two times was the start of COVID and the end of the great financial crisis. But that's where we are in home sales activities, right? And that sets the stage for what we're going to talk about tonight. You can see it's not localized to one area, it's nationwide. These are pending sales by region year over year for the first 3 months of the year. And it's not just one area, it's everywhere. Everywhere is down, fewer sales across the country. The drop is muted in the Northeast and Midwest, a little stronger in the South, and then the worst is out here on the West Coast, right? And you could probably imagine with the trend you see there, if we just settle in on the West Coast and on California, it's even worse. Here's Santa Clara County. This is all units, single family and condos and townhomes in Santa Clara County. And I want to show you that trend that they start talking about, collapse in sales. It's happening here at a much more dramatic rate. So far, year over year sales are down 43.5% in Santa Clara County. Quick reminder, Northeast down 17, Midwest down 17, South down 22, West Coast down 28, Santa Clara County, where you and I live, where we operate, where we work, down 43.5%. Basically in half, right? Now, is that good or bad for sellers? Generally, when you're having fewer sales, dramatically fewer sales, that generally tends to mean, well, then buyers don't want the product or the service. They're not taking the time, making the effort to transact in that good or service. But if you start with that premise, you would be wrong. Because there's another part of that equation, of course, and that's, well, what's available for sale? What's the availability of the product or service? If that is high while demand is low, prices will crash. But if that supply is low and dropping while that demand is consistent, that bodes well at the very least for maintaining prices. So if you're a seller out there and you're reading words like crash, you've seen sales are down 0.5%, 50% almost year over year. Don't panic, don't worry, your home is not losing value. If it is, it's not because of that, I can assure you of that. If you're a buyer and you're thinking, finally, after over a decade, prices are gonna fall, I can buy a house at a lower price than I could have a year ago, 2 years ago, 3 years ago, you might be in for a problem there too. And I'm going to explain that in a second. But let's deal with the supply side first. And I have here, if you can see my, mouse, you can see that first quarter, the dark bar is number of properties sold in January, February, March. The lighter bar is for sale. If you compare the for sale, January, February, March, it was less than January, February, March of this year. So number of homes on the market is growing. The supply is larger. And so you'll read that inventory is growing after 2 years of really, really low inventory. Finally, we have more options. That is also something you have to be very wary of. And I'll explain that in a second. We do have, as we record, more properties for sale. But I want you to look at some of the fine print here, as I call it. And that is new listings. This is the blue line, the number of new listings on the market. You can see this blue line, January of last year, 1,051, February, 1,300. By March, we had 1,800 brand new listings that month. We are way below that level this year. January, there was around 600 to 800. Now we're barely hit 1,000 brand new listings March of this past month. Now, A new listing is recorded once. It can only be new once, right? But if you list in January, you record it as one new listing. If it doesn't sell in January, it will be count as active inventory in January and in February. It's counted twice. If it lasts 61 days, it's counted 3 times. That is where you're getting the growth in inventory. In effect, it's the properties buyers don't want. So be wary of that. If you're a buyer in this market and you read the headlines from the previous year and saying prices are going to fall, inventory is going to rise, you're going to have more choices. You can make lower offers, you can compete, and you don't have to give in to the sellers. That is true if nobody else wants the house you like. If you like that turnkey home, which most buyers do, it's a very, very heated market. It is moving very fast. We're back to multiple offers. We're back to over asking price bids. So there's a lot hidden in there. As a buyer, inventory is rising, but new inventory is declining. That means the most choice properties are going fast, and there's a subset of homes that are lasting longer and longer because they're not as desirable. If you're a homeowner and you are primed and ready to earn the highest and best dollar, then you want to try, if you can at all, to make your home as ready for sale as possible. Making upgrades, making changes, making sure it sells in that first week or two. That's when the bids are highest. That's when the frenzy will be there and most likely deliver you the highest dollar value for your home at the current time. So it might sound like I'm talking out of both sides of my mouth, but this is why I use complicated slides like this. It very much matters what your house, what the shape of the house is, what is the condition, what is the timing, what both buyers and sellers. We can talk in generalities that overall the market is moving very fast, multiple offers on property, but that's not for all of them. So again, whether you're a buyer or seller, you've got to understand what you're looking at, what your goals are, and how to create that opportunity, no matter what side of the ledger you're on. But here's the reality. Overall, way fewer transactions. After all, you can't sell what's not on the market. And if we're not replenishing the new listings on the market, then naturally sales are going to fall. There's that transaction crash that was referenced in the previous slide. It is not a price crash. Be very wary of that. Again, whether you're buying or selling, of misreading a headline that's talking about crashes or sales are down year over year. It is not referring to price. And as an individual buyer or seller, the reality is that the price movement is more important than overall activity in the market. Obviously, overall activity contributes to the price. That's one of the factors. It's an important factor, but that cannot be the driver of your decision-making when you're either writing offers or receiving offers for the sale of your property, right? Do a quick check if there's any questions. Nope, there's not. So we move forward. So this is a great article from Fortune. If you're a bear, if you like to read what the worst that can happen, go to Wolf Street. If you like to read positive stuff about real estate, go to Fortune magazine. Lance Lambert, always writing. He blogs, he tweets, he publishes articles weekly, almost weekly on the markets. And they published this one this week, and I thought it was excellent for this week's discussion. And it starts out saying, most housing analysts expected 2023 to be a rough year for the U.S. housing market. In fact, among 29 major housing forecast models, 24 forecasted a national home price decline for 2023. But so far is important, that hasn't exactly come to fruition. So far, after the first quarter, that idea that prices were going to be impacted negatively, that they would fall, that housing would become more affordable, has not come to fruition. In fact, in many cases, the opposite has happened. Prices are rising in some neighborhoods. Through the first few months of 2023, the U.S. housing market continues to show signs of stabilization. Existing and new home sales have inched up a bit this year, and home builder confidence has improved. And firms like Zillow, CoreLogic, and Black Knight have all reported positive month-over-month home price increases this spring. Very important. Again, most buying and selling decisions don't take days or weeks, they take months. So you might be listening to this And you may have started to think about buying or selling as far back as 9 months ago or a year ago. And if you started thinking about then, all the news was negative. And it wasn't without reason. A lot of the leading indicators were in fact really looking bad. And so it stands to reason that publications and firms like Zillow and CoreLogic are saying, hey, 2023 is going to be bad. Prices are going to fall. Homeowners beware, buyers get ready. And they were right until they weren't, until the data changed, until the realities on the ground created a different reality. What's that reality on the ground? Inventory did in fact fall, but buyer demand remains steady. It was not and has not returned to the heyday of 2021, 2022, at least first quarter 2022, but there's more than enough demand to not only buy the existing supply, but pressure the prices upward. And they continue and they say, under the hood, the housing market isn't exactly normal just yet. Some housing markets are booming right now, including Scranton, PA, while other places, including San Jose, are still passing through a home price correction. I joked earlier this morning with a group of agents, I go, in San Jose is in fact going through a home price correction. It was too low, it's getting higher. Again, they're not wrong here. They're talking around all the properties in all the neighborhoods in San Jose. And some are experiencing some price corrections, but other parts are incredibly in demand, undersupplied, overbid, and prices are moving up quickly, 2-3% a month in some cases. So I recognize that generally you don't, as a consumer, get your first taste of what's going on in the real estate market from any one of us. It's probably from somewhere like Fortune or from Zillow or from the Wall Street Journal. And always understand, they're always talking to that 30,000 foot view. Their audience is not necessarily a buyer or seller. It's just the general public interested in the topic. Of course, in that group, there are active buyers and sellers. But always know, whatever they're writing, you have to take it. It sets the mood, it sets a tone. But then you've got to distill into, what about your neighborhood? What about your block? What about your property? And that's what we're here for this evening, right? So big picture, low inventory, enough demand so that prices in most neighborhoods in our area are actually rising the first quarter, not falling. So what will change that? It's got to be one of two things. Demand changes or supply changes. So I pulled this up from Goldman Sachs Mortgage Forecast. And the first thing we notice is that we don't expect dramatic drops or rises, for that matter, in interest rates over the next 12 months. There is going to be some up and down, but probably in the range of 6.7, 6.2. We should be in there pretty consistently over the next 12 months. So unlike last spring, where at the end of the spring, we got this shock from going 3 to 4% to 7% and freezing the market for a while, we shouldn't expect that. Buyers now know what to expect when they're looking for a house. If they're going to get a mortgage, what they should expect to pay in terms of an interest rate. So get that volatility out of the way. What about supply? We can go working backwards. We estimate that there will be about 1 million purchase originations this year, 1.156. They expect that to grow slightly, very slightly nationwide next year, 2024, to 1.2. So again, you see no major shifts expected nationwide in price, supply, or demand. So that sets the table for us nicely here to start talking about what's going on locally, right? Applications, buyers interested in buying, while collapse is not too strong a word to describe what happened in the last 9 months. We're down 30-40% year over year in people applying for mortgage applications. We have been steadily rising week by week since November. That's a full 4.5 months now of that buyer demand growing. And that's what I was referring to. But we don't have quite the frenzy that we had 12 months ago, because the buyer demand has dropped. It is still healthy enough and large enough and growing to more than take up whatever supply we put out there. Those are going to be the driving forces going forward. In terms of supply, this is nationwide, 18% fewer new listings each week than last year. That's nationwide. What about here? I'm going to give you a sneak peek of that, but you can see again, isolating the new listings in March, we were down by 30–40% of new listings. So we're not feeding that new supply. Supply will remain low locally for the foreseeable future, certainly for the next quarter, likely for the next year. Nothing on the horizon is showing anything that's going to dramatically increase the number of new listings and therefore the overall supply in our market. As a buyer, you can't wait until supply doubles, gives you more choices and allows you to compete in that manner. If you're thinking of buying, expect this level of inventory for the foreseeable future. Again, if you're a seller, you're not going to be worried about too many properties out there competing with you, keeping that pressure on prices consistent and constant upward. Worst case scenario, flat. And again, you can see here, this is another great site if you're interested in this kind of data from Redfin. It's a great place. I don't mind saying that. They're technically a competitor of ours, but they produce great information. What we like to do is we analyze it better than they do. So I don't mind sharing it. And you can see again here, supply, new listings in San Jose. We started right below where we have been the last few years. And you can see it has maintained that low level of supply. 20, 21, 22, 23, all low supply years, all years where home prices appreciated because there were so few houses that buyers had to compete for. That's not going to change. I don't want to know what would happen in our economy to drive the number of homes up to compete even where we were in the previous 3 years. So expect that to stay like this for a while. So let's get into what's going on here, our county. This is an example. I'm going to show you the next 3 slides of if you wanted, if you were interested, having one of us, again, in your home, at a Starbucks, on a Zoom, going over exactly what's going on in your neighborhood. What you see on here and how I will describe what's going on with single family residents in Santa Clara County, we would do for you and your neighborhood to give you a good idea what's happening there. So a lot going on here, but I like to distill it to some really simple things. And then if it generates more complex questions, happy to answer them. But rule of thumb, 20 years experience, every week I open up this slide and I look at the blue and the red line. And that's because the blue line, again, is new listings. The red line is pending. Those are people who see a house, offer on that house, and make an offer to buy it. It takes it off the market. It hasn't closed yet. It hasn't become a transaction yet, but it gives us a really good idea of what's the buyer demand out there. And because it hasn't closed, it's forward-looking. So it tells me whatever one pending this month is going to close next month and be reported the following month. So I get a 60-day window into what's the buyer demand out there. When I see that red line close to or even passing the blue line, I know the pressure on prices is pretty intense. I know that the buyer demand is outpacing the supply and it's going to naturally drive prices up. It's going to generate multiple offers, and it's everything else being equal is going to raise the price of comparable homes month after month after month. When they detach, like they did when interest rates hit 7%, all of a sudden sellers still want to sell, but buyers are saying, no, thank you. Not at 6%, not at 7%, not at 7.2%, and at that price. So when we saw this, we immediately knew sellers are going to have a problem if they're not open to different offers. Likewise, we knew buyers had an opportunity. Some sellers might panic in that regard and sell too low because they're used to selling in a week or 2 weeks or 3 weeks. So we always have a really good sense 30, 60 days out of what's the market holding. So imagine when you're asking us what's going on with the value of my home, most realtors will tell you, well, this is what's happened last month. These are the comparable prices. This is how we'll price it. What we do is we say, this is what we expect in the next 30 to 60 days. And that's where we advise you on price. Again, whether you're buying or selling. But this is just one piece of it. We can look at, you can see down below, the number of new listings, February to March grew by 28%. Pendings grew by 17%. Why does that matter? Again, new listing, that's already happened. It's been recorded. It's being made available for sale. Pending is a buyer said, I like it, take it off the market. Whenever you see new listings growing faster, that's static, that's recorded. Pendings will record in 30 days. If that's not keeping pace, that means those lines are going to move apart. And so I can tell you something that you've been listening for a couple of weeks. We said we may have already peaked in this metric. Have not yet peaked in price, that lags. But if you're thinking of buying or selling, I think you have like a 30 to 60 day window on maximizing buyer opportunity in this market. That doesn't mean you're going to lose money if you can't sell until July or even the fall, but less likely that you're going to receive multiple offers the first weekend. So it will extend the time that you're on market to get top dollar. It will extend carrying costs because you're not going to sell it in 1 week or 1 day, more than likely. So it doesn't mean you should be pressured to list immediately unless you can. If you can, you're more likely to get top dollar when this pending number is equal or greater to the new listing number. Another metric that we use is this absorption rate. Absorption rate, again, very important. It measures the appetite of buyers in a given market, regardless of how many homes are on the market. And so anything above 33% is considered a seller's market. You can see clearly, even when things were bad last summer, we were still in a seller's market. It didn't feel like it because when you're coming off highs of 180, 215% absorption rate and you drop to 58, that feels like you're losing, but you weren't. You were just squeaking out victories. You weren't blowing the other team out. You were winning by a point, but you still won if you're a seller. Conversely, if you're a buyer, these are the times when you have more negotiating power. It is still a seller's market, but not to the level it is in other periods. So we started seeing again in November when we started to see the number of people applying for mortgages growing week over week over week, that we felt that's going to put pressure on prices upward. We started telling our buyers and sellers that, and it came to fruition. And we saw that it rebounded nicely from January to February and March. And you can see it seems to have peaked. In fact, we went from 115 to only 118. That's still a great market, by the way. Don't misread what I'm saying. We're still in a great market. But if you're expecting to receive the number of offers and types of offers over asking price that maybe your neighbor did in February, likely won't happen. You'll still sell for more. Don't forget that. You'll still sell for more, but it won't seem as sexy, right? You may only get one offer, but you'll still make more money if you price it right, if you time it right. Now, you can see here month to date, it's dropped to 114. Still not a big loss. It's still not a negative. That's still a very strong market. But again, talking about timing, if you were thinking of July, August, September to sell, if it's possible, maybe it's better to move that timeline up. Because typically what you see when you get incredibly strong starts to the year is there's usually a given number of buyers in any market in any given year. If you push them forward into the beginning of the year, then you'll have fewer in the last half of the year. And while there's still good markets to sell in, they're not that highly intense multiple offer situations that you'll see there. So we expect the apex to be lower this year than last, but we do expect the same general trend. We should taper off, and because we've already tapered in not only March, but the first 19 days of April, we can expect a return to maybe double digits in the coming weeks and months. Still a good market, still a strong market, still a seller's market, but that recency bias, if you've been reading headlines of 50 offers, 200K over asking price, maybe that's not the market we're coming into. And then bottom line, all these things generate, what's the dollars involved? How fast do we move? You can see again, the faster houses are sold, the less time they spend on the market. That's an indication of buyer demand. It relates to that absorption rate, and it results in offers way above asking price. So that first part of 2022, 11%, 15%, 16% over asking price. It tabled off and fell to just below 100% for the most second half of 2022, but recovered again in January, February, March, all predicted by the increase in buyer activity through applications in November. You always have lead time and future looking indicators to tell you what's going to happen next. And that's where we excel. We do everything else other realtors do. We'll stage your home and make it beautiful. We have the contractors and handymen to help make improvements if needed. We're going to work with the best photographers and videographers to put your home in the best light. But those are givens. Those are the baselines for realtors in Santa Clara County. If they have any quality, any skill, they have to do those things. Where do we stand out? We stand out in really analyzing the data and giving you not only a synopsis of what has just happened, what is the environment, but what we expect to happen in the next 30, 60 to 90 days to give you the best possible advice around buying or selling real estate in Silicon Valley. So again, you can see here, lagging numbers, while the first lead indicator of absorption rate is trending down now, usually the prices lag, and you can still see we're still going up from February to March, and even through April, we're at 114. So I know that was fast. I know that was a lot. And to be honest, it's not designed to give you that granular look. What I will hope to do is just give you a background of the kind of detail and the kind of analysis we put into understanding these markets. When you communicate with us, when we sit with you and we talk about your wants and needs, we're going to bring this level of analysis and guidance to you to help you make the best possible decisions around buying or selling real estate in Silicon Valley. I hope you take advantage of our experience, our background, and our ability to guide you and help you make some incredibly important decisions around buying and selling. With that, if there's no questions, whoever invited you to this, whoever sent you the invitation and or the recording, if you like that personalized consultation, reach out to that person, set it up, and I'd love to meet you and love to discuss this with you. With that, have a great evening, and we'll see some of you next week. Thank you.